AI capital spending is exploding just as yields push back toward historical highs and energy prices threaten a new inflation wave, forcing allocators to reassess risk across every major asset class. Welcome to vTalkInsight, Allocator's Lens Daily for August 12, 2026, where we connect equities, rates, credit, FX, and commodities into one coherent portfolio story. In equities, the dominant story is the collision between powerful earnings and an unprecedented AI capital spending boom. That combination is keeping global stocks resilient, even as long-term yields grind toward multi-year highs and inflation risks from energy and food start to creep back into focus. On the fundamentals, profit growth looks unusually strong and broad-based. S&P 500 median earnings growth is in the low teens, with overall earnings growing close to 30%, and net income margins and sales both beating expectations by notable margins across most sectors. Importantly, this is not just a handful of mega-cap names. 10 out of 11 S&P sectors are showing positive earnings. The equal weight index has printed new highs, and in Europe, second quarter net profits are running roughly 17.5% versus about 11% expected, with the DAX helped by AI software, defense, and infrastructure names. AI remains the key equity growth engine. Data center capital expenditure by major tech firms is on track to exceed $1 trillion this year, with AI infrastructure spending projected around $7.5 trillion over the next 5 years, and companies from NVIDIA and Supermicro to Vertiv, SiteTime, GXO Logistics, and even former Bitcoin miners are reporting powerful demand for compute and power capacity. Investor positioning reflects that enthusiasm. Exposure preferences to AI-related equities have jumped from the high 20s to the high 40%. Option skew has flattened as traders favor upside calls over downside protection, and volatility indices are sitting in the mid-teens, all pointing to a renewed risk-on stance rather than deep caution. Against that strength, the risk side of the equity ledger is getting heavier. Valuation concerns are building as AI hardware faces potential commoditization and GPU lifespans remain uncertain. Hyperscalers deliver earnings beats tied to very rate-sensitive Capex. And some AI infrastructure players, such as CoreWeave, already pay close to 10% on debt, while earning around 1% on assets. Credit markets are also sending early warning signals. NVIDIA's credit default swap spreads have moved more than 20 basis points above those of large hyperscalers, highlighting rising concern about leverage even as its equity story remains strong. And that divergence underscores how equity valuations are becoming more sensitive to any disruption in funding conditions or in the AI demand narrative. Macro and policy risks amplify those vulnerabilities. 10-year Treasury yields edging toward 4.8%, with talk of 5% as a potential line in the sand, hotter than expected inflation data that could revive stagflation worries, and higher energy and food prices all represent catalysts that could challenge today's optimism, especially given the relatively light demand for hedges. In rates, the picture is one of higher for longer being reinforced by both cyclical and structural forces. Persistent above-target inflation, massive investment tailwinds from AI and energy, and large fiscal deficits all suggest that policy may need to stay tighter for longer than markets had assumed earlier in the year. Federal Reserve officials have signaled that multiple additional hikes may still be on the table, and market pricing keeps near-term hike odds above 50%, even after softer payrolls and signs of easing in labor costs and housing inflation. The message is that single data points are not enough. The Fed wants several months of consistent disinflation before shifting its stance. The recent rise in yields is driven mainly by higher real rates rather than by inflation expectations, which remain well anchored despite oil near $90. 10-year Treasuries hovering in the high 4% area and 30 years near the low 5s reflect a mix of term premium, concerns about large fiscal deficits, and heavy issuance tied to AI and other capital-intensive projects. Several observers flag 5% on the 10-year, especially if reached via real yields, as a potential stress zone for growth and financial stability. If a market tests that level, it could force a more cautious tone from the Fed, but until then, investors are likely to keep pricing in the risk of additional tightening while watching every inflation and energy headline. At the front end of the curve, one-year Treasuries around 4% illustrate the dilemma. Nominal yields look attractive, but real returns are uncertain if inflation proves sticky, which is why some allocators are focused on active strategies across the 0 to 5-year segment that can target closer to 5% nominal while managing duration, liquidity, and credit risks. With long-end volatility driven less by inflation prints and more by growth uncertainty and supply, the rate complex remains the primary transmission channel into risk assets. How the curve reacts to the upcoming inflation data and to any further rise in real yields will be critical for both equity valuations and the cost of capital in credit. Credit markets sit at the intersection of AI's funding needs and the higher rate environment. Demand for capital is extraordinary, particularly from AI infrastructure projects, while the cost of debt is rising and investors are becoming more selective about which balance sheets can handle that leverage. NVIDIA's plan to mobilize roughly $500 billion of financing in partnership with major banks and private equity firms is emblematic. GPU clusters are increasingly being treated as collateral in their own right, turning AI hardware into an investable asset class that can secure loans beyond the traditional focus on borrower credit quality. New asset-backed products for AI chips and compute are being designed, with some comparing them to aircraft leasing or receivables financing. There is active debate about repackaging AI hardware loans into securities, which could broaden investor access but would also introduce another layer of leverage and complexity into the system. Tech sector debt issuance is already surging on the back of AI Capex, contributing to upward pressure on Treasury yields and reinforcing the idea that current financial conditions may not yet be restrictive enough. At the same time, companies like Intel opting for very large equity raises instead of additional borrowing signal that for some issuers, the marginal cost of credit has become too high. Under the surface, pockets of stress are visible. NVIDIA's credit default swap spreads have risen more than 20 basis points above those of hyperscalers, such as Amazon and Microsoft, and CoreWeave's nearly 10% borrowing costs against roughly 1% returns on assets highlight the risk that some AI business models cannot carry their debt loads if conditions tighten. The concern is that a rapid expansion of AI-related financing, much of it debt-funded and increasingly securitized, could create systemic vulnerabilities if demand disappoints. Private equity valuations are now significantly cheaper than public markets, attracting capital into alternative assets, including large sports franchise deals, which diversifies exposure but also deepens the network of links between banks, private credit, and AI-driven cash flows. In currencies, the U.S. dollar remains the anchor, supported by relatively strong U.S. macro data and its safe haven role as inflation and geopolitical risks persist. The expectation from many participants is that dollar strength can continue for several more months, especially while U.S. rates stay elevated. The yen is the clearest expression of policy divergence. Despite expectations for a Bank of Japan hike, repeated currency interventions, and official concern, the currency remains weak as markets doubt that policy will move decisively toward a neutral rate around 2 to 3%, or that clarity on bond supply will be forthcoming. Japanese pension funds and corporates continue allocating capital abroad, reinforcing that pressure. Sentiment in Asia increasingly points to the possibility of dollar-yen testing the 170 area over time, with interventions seen as temporary speed bumps rather than a durable solution unless the Bank of Japan genuinely tightens policy. The euro faces a different but related challenge, as high oil and gas prices raise the risk of stagflation across the eurozone. Central banks, such as the European Central Bank and Bank of England, may be pushed toward tighter policy to contain inflation, which supports the currency through higher carry, but also intensifies growth concerns and leaves European FX vulnerable to negative energy or geopolitical surprises. Within digital assets, Bitcoin stands out as relatively subdued. Even with rising institutional interest and miners pivoting toward AI infrastructure deals, prices are described as stagnant, suggesting that the current risk-on phase is being led by equities and credit rather than by crypto, and leaving cryptocurrencies more as a secondary expression of risk appetite for now. Commodities are the swing factor for both inflation and growth narratives, and energy is at the core. Brent crude is trading close to $90 a barrel, with West Texas Intermediate near 85, as stalled negotiations and hardened positions between the U.S. and Iran keep the risk of prolonged disruption in the Strait of Hormuz elevated. The U.S. Strategic Petroleum Reserve is at a roughly 40-year low, limiting the ability to cushion further supply shocks. At the same time, reports of dark ship transfers and ship-to-ship operations highlight efforts to route barrels around restrictions, underscoring how geopolitics is now deeply embedded in the oil risk premium. Europe faces its own energy crunch as winter approaches. Benchmark gas prices have roughly doubled into the 50 to 60 euro per megawatt hour range. Diesel is up around 10% this year, and German storage levels look uncomfortably low, all of which push up production costs, squeeze consumers, and feed directly into the weaker euro and higher inflation narrative. Industrial metals send a slightly different message. Aluminum prices are supported by supply tightness linked to energy-intensive smelters, Gulf disruptions, and the technical difficulty of restarting capacity, while China is already running near its production ceiling, and both aluminum and copper are benefiting from incremental demand tied to AI data centers and electrification. Food and precious metals round out the inflation story. Risks of a food price shock from poor European harvests, disrupted Ukrainian grain exports, and El Niño are seen as underappreciated and could derail hopes for smooth disinflation in early 2025, while gold is rallying on central bank buying, renewed exchange-traded fund inflows, and classic hedging demand ahead of key U.S. inflation data. Across assets, the picture is one of powerful earnings and AI-driven growth colliding with higher real yields, heavy fiscal and corporate borrowing, and a renewed inflation risk from energy and food. Equities still look supported by profit momentum, but their duration is lengthening. Credit is quietly absorbing an unprecedented AI financing wave with new structures and rising pockets of risk. The dollar remains firm as the yen and euro struggle under policy and energy burdens, and commodities are keeping the inflation debate very much alive. For allocators, the key is how the next inflation data, the behavior of the 10-year yield around the high 4% area, and any further escalation in energy markets interact across these asset classes in the coming weeks. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.